Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about our theory on resort town hyperinflation. We're also going to do a residential real estate heat check. And last, it's back to school, so we're going to talk about some education stuff. Justin, first up, we're talking about resort towns and hyperinflation. You and I had some kind of interesting conversations in our Slack message talking about this. I would love for us to just kind of unpack for the listeners why we have concluded that resort town and luxury vacation inflation is going to massively exceed inflation in all other segments of the economy. And let me caveat this by saying this doesn't impact how we think about investment portfolios. We're not market prognosticators. We're not making claims about where we think interest rates are going or changing the structure of client portfolios. This is us just exploring our curiosity about macro, which in all honesty, no one has any idea what they're talking about. So this is not actionable advice. It's just us having a conversation, a hypothetical conversation.
That's a really good caveat because, Jared, we are not necessarily predicting that prices in, Steamboat Springs, Colorado, or insert any one of your favorite, remote mountain towns. We're not predicting that any of these places are going to continue to explode even further in price. Maybe they will, but it's largely a separate discussion. And the interesting topic that we really want to hit at is these towns have exploded in price so much, specifically in the last 3.5 years, but also in the last 15 years, that they now can no longer operate in kind of a free market economy. And what I mean by that is if you are in just an incredibly expensive mountain town or beach town, and let's say that you are hours away from the nearest major airport, hours away from the nearest major metropolitan city, you have a very uphill climb in terms of how do you house the hundreds, but Jared, it's really thousands of people that you have to have in your town to do simple hourly tasks. And so we take it for granted, but our cities and our towns really can't function unless we just have an enormous amount of people that are able to unload food trucks, that are able to stock grocery shelves and do, dozens of different small tasks that must be done for humans to live in a place in the manner that we currently live. And so the conundrum is, what in the world do you do if you are, let's just pick Telluride, and you're in the middle of a mountain town. You're not anywhere near a major metropolitan city, but you still have tens of thousands of people that spend regular time there. And so how in the world do you provide the infrastructure that you have to have for, tens of thousands of people to exist when the cheapest house is $3 million?
Yeah, Telluride's a great example because I was looking this up as the population as of 2022 was 2,588. I guess that's got to be full-time residents. That number doesn't even seem believable to me. But even if it's
full-time residents, yeah.
Even if it's 10x that, there's still a capacity issue, right? Because the thing is, there's not enough infrastructure. Telluride is an expensive place to live. So people who live there full-time probably need way more than an hourly task to make the economics compelling. Even if you have a really great resort and can convince people and pay them above average wages, you have to source these people. You can't employ 100% of the town to run an operation. And if you're running a 5-star, boutique experience with experiences and skiing and excursions, you need you need hundreds of people to execute that at a high level.
That's right. Jared, I remember about 10 years ago, this ultra luxurious hotel just absolutely in the middle of nowhere opened. And I think it's called Amanjiri. I'm not sure if you're familiar with what I'm talking about, but I believe it's in the Moab Desert. And the Aman, AMAN hotel chain is just an extremely upscale hotel chain. And you look at this and you do begin to wonder, how in the world does a place like this operate? It is so far away from civilization. And so how do you have the ability to hire staff to run this? But then you really think, well, take a place like Aspen or Steamboat, and it's that on a way bigger scale. The entire town is just as expensive as a 5-star ultra luxurious hotel. There is no cheap option to stay there. And so how do you have the 1,000 or 2,000 people that you need to do hourly tasks? And I will give one interesting example, and then I'll give it back to you. Steamboat. So, we had Terry Nixon on the podcast. Terry retired to Steamboat. So he retired from Houston after running his own oil and gas firm. He retires in Steamboat, and Steamboat had a massive problem with this. And eventually, I want to say that a billionaire just subsidized the entire thing and basically built like a little village for full-time workers to live. And I think that's kind of the story here. I think you have to have an ultra wealthy person that completely subsidizes this problem and essentially pays for, 1,000, 2,000 people to live there, or at least do that at different parts of the year to support the infrastructure required.
Yeah. So there is a supply of labor problem, right? The other problem is that we haven't even talked about yet is there's a demand problem. People who own assets, the thing about the run up in assets is people who owned assets 5 years ago have had their assets appreciate. So everybody's wealthier on paper, which is great, but then the prices of all these things have gone up, right? So the type of person that gravitates towards these resort towns, they have more in assets, right? So they can put more forth, which is kind of why we're seeing the increase in prices in the first place, right? So supply is constrained in terms of people that want to work there, but demand is increasing, right? Is economic prosperity in a country like America that I don't know the data, and I'd be curious to find it, but there's substantially more decamillionaires than there were 30 years ago, right? Like that the number of people that are willing to live in this resort town and kind of endure, or maybe have a private flight direct, like that is an increased universe of people, right? And then so it's supply constraint in terms of the people. It's also probably supply constraint in terms of the land, right? Because when you're into these beautiful locations, there's probably nature contingencies. There's people that own big tracts of land that are never going to sell it, right? Like it's not exactly just like open season in terms of available inventory. So you have an inventory problem, you have a personnel problem, and you have a demand problem. And it's only, I only think it's going to accelerate, right? If you think about, we're talking about die with zero, the average person inherits at 58, inherits money at 58. If we think about this big wealth transfer that's going to take place, if people are inheriting at 58, you've had to build your own financial sufficiency by 58, right? Like that's a long, you can't just wait that long to build your own empire, right? So right. When you inherit all this money at 58 and you've, in your highest income earning years, the percentage of that that can be allocated to discretionary is very high.
Very
right?
high.
If a 20 to 30-year-old is inheriting it, like they're going to spend it on a first home. They're going to spend it on, sending their kids to a nice private school that they might not otherwise afford. They're not going to spend it on a second house in a resort town. But if everybody inheriting this money is inheriting it in their peak earning years and they've already accumulated substantial assets for themselves, a lot of this is quote unquote gravy. So, a seemingly logical place for it to go would be to getting a second residence at resort towns. So all of those things I think are demographic kind of tailwinds to increasing demand, which actually makes the economics of resort towns, gives them a headwind.
Which, Jared, the tangent topic to this is I gave this disclosure at the beginning of my diatribe, but I have no idea what's going to happen in prices here. So listings are just through the roof now in many of these resort towns. Nothing is selling. Real estate is sitting stagnant. But I really do think the typical or kind of, the median balance sheet of somebody who owns a home in Rosemary Beach or in Telluride or insert any other really expensive place. The median balance sheet of that vacation homeowner, is way stronger than it was 10 years ago, in my opinion. And so I think there are an enormous amount of people that can now eat that cost instead of being forced to liquidate at a bad time. The inheritance age is just so fascinating. When you inherit past 50, you are not inheriting money that goes to paying your monthly bills. You've already checked that box, and it's going to fund purchases.
Even if you know it's coming, you cannot wait decades, right? You cannot financial engineer overspending for decades, right? You just mathematically cannot do it.
That's right.
Even if you know your parents have $10 million, you have no idea when you're going to get it or how much is going to be left by the time you get it.
That's right.
And kids, expenses, those are all today. So I think that's another thing. But I mean, the other thing that kind of impacts the supply equation that we haven't really talked about is there's a finite number of towns that have the infrastructure to support like really good travel, right? And proximity to closed towns, right? So like there's probably, hundreds of locales in Wyoming that could potentially be, be super resort towns. A, they don't have the people, and B, they don't even have a way for people to get in and out easily. Right. So like there's not just infinite number of places that are beautiful enough to really charge the upscale price and accessible enough to where you pull in from a wide demographic of people from all over America.
That's right.
Justin, anything else before we move on to the next thing?
I think that covers it. It's just an interesting conundrum. How do you function in the middle of nowhere when everything is super expensive? So fun to think about.
Yeah. And again, not investment advice. Do with it what you will. I would love to hear if you disagree with us. We're just prognosticating. I can't, maybe we should play it back in 10 years. We should do a follow-up episode to see how freezing cold our take was or how prescient it was.
Yeah.
Either way, we're going to learn a lot. Okay. Awesome. Speaking of real estate, let's do a residential real estate heat check, right? Like we are recording this in August of 2024. I just got a text today from my mortgage banker talking about, hey, rates are moving down. You could save X number of dollars if you refinance, right? Trying to get activity going. Rates are starting to move down a little bit. Fed hasn't cut officially. I'm curious, Justin, I don't know what it's like down in Fort Worth, but in Arkansas, inventory is starting to sit longer. You're seeing more price cuts than you maybe were a year ago. Things are slowing down. I would love to hear what's going on in Fort Worth. And then what do you just think generally about residential real estate right now?
I think it is, similar to Northwest Arkansas. We're seeing way more homes being listed for sale, and those homes are just sitting way longer. Stuff is not selling, nearly as fast as it was during the boom. And there are a lot of, different market analysts, real estate market analysts that look at this and think that, hey, DFW's in trouble. And different Texas markets are going to face massive, price pullbacks. And I still have a hard time really figuring out what I think is going to happen. I still think there's a chance that prices can hold relatively high. And Jared, that's the thing about this, that when you get into markets, it's not really helpful to say, I think this is going to happen. Instead, it's helpful to say, I think there's a 60% chance that this happens. I think there's a 30% chance that this could happen. And then there's a 10% chance of this happening. And I think that's kind of where we're sitting now. I think it's a small chance, but a real chance that we see a serious real estate drop in Texas. But there's still a great chance that it's able to hold value despite significantly more listings that sit for longer.
Yeah. I mean, the interesting thing is like, a meaningful housing correct. Like these 3 years have been such an anomaly. What does a 20% haircut on get everybody back to, right? Historically, homes have inflated at what? 3 and change percent.
Yeah.
Depending on where you live, it's appreciated 20, 40, 50% over the last 100% over the last 5 years.
Yeah.
Really, like even if you had a 20% drop, where does that get us back to where your house was worth maybe 2-3 years ago?
That's the other thing we've mentioned on this podcast before, Jared, but asset classes do have the ability to get all of a decade's worth of returns in a 2-3 year window. So that may have happened. It's entirely possible that, some houses in some areas went up by just an unbelievable amount from 2020 to 2022 and a half, let's say. And that might have been the lion's share of the returns we're going to see in some of these real estate markets for the entire decade. So tough to tell.
But that's the thing, right? That's why you cannot time the market, right? Because if it was a linear 8% up or down and you knew when that was going to happen, you would just say it's the same with stocks, right? Like over a long-term period of time, stocks return, 8%, 10% before inflation. The number of years where it returns between 8 and 10%, it's like less than 10% of the time. I think it's even less than 5% of the time. right? So like the long-term average and your lived experience year in and year out are two very different things. But kind of like you said, right? Like I think mean reversion over a long period of time is like very helpful, right? Like if, things become overvalued or performance is way good the next 2 years, appreciation of homes is really good the next, the last 3 years, I think over the next seven, I think it probably, there's more downward pressure than upward pressure.
Absolutely. Jared, I'd be interested to get your thought on this. If you are, how much pressure or how enticing is it to refinance if you are not necessarily in your forever home yet?
It's not really compelling, right? Like if you think about it, also it's a function of time horizon. If you're not in your forever home, like refinancing a home is not a cash free transaction, right? There are a
Yep.
lot of fees that go into refinancing. So it's like, okay, how much am I going to get in terms of monthly savings? And okay, how much is it going to cost for me to refinance? And even if it is going to save me, let's say $100 a month, but it's going to take a few weeks of work. Okay, what is that worth to me? So like, I don't think I'm going to be in this house long enough to do that. It's just not really compelling yet, right? But like,
Yeah.
here's the thing, Justin. It's important to remember I'm in the minority, right? Like if you think about the percentage of people in America that have an interest rate over 5%, it's like 70, I don't know, 80%. And I hope the people in YouTube comments will correct me and kind of give me the facts. And directionally, I think that's right. But like, here's the thing, and here's why I don't think, or I think a 20% housing drop is going to be tough, because people with low mortgages, like they have a tool that is not available to them, right? Recreating their home purchase today, even with all the equity build at a 7%, 6.5%, 6% mortgage rate, if they have 2 or 3% today, that's a big bump up in monthly payment. It's like the marginal buyer is really discouraged from doing that, right? So like there's a lot of people that if interest rates were at 2% would sell and move, but interest rates aren't at 2, and I don't see them going to 2 for a while. So I think that is going to create a baseline ceiling in terms of how many houses really start to meet the market, meet market, right? As interest rates go down, I do think more marginal sellers come online. But I think because so many people are so locked into a low rate, I don't think, if rates go to 5%, there's just going to be a massive boom of supply, which you have to get for prices to go down.
That's right. And Jared, you said, it was a guess, but around 70%, a majority of people have an interest rate below 5%, which means that, there's pressure to stay. And, I think there's just negative sentiment in both of the places that I spend a significant amount of my time in the greater Houston area and DFW. I think both places are thinking, hey, things are looking bad. Nothing's selling, stuff's sitting. But Jared, are things bad, or are things not just screaming amazingly great like they were in 2021?
Yeah, like is the housing environment where people are foregoing inspections and paying all cash, is that what we want to go back to?
Yeah.
Like no, like this is more like the last 100 years.
Great.
Like right? And it's like we're kind of return to normalcy. But like lunacy was so much more profitable to your balance sheet that we're kind of like, like, oh no, things aren't appreciating 10%. Wait, I might have to cut my price and negotiate with somebody versus just having them buy it sight unseen, all cash with no inspection.
Yeah, it is. It's so much more similar to what it's been like for a long time. I used to love, Jared, did you ever watch those real estate shows? Whether it's House Hunters on HGTV, or I think it's on like Bravo. It was the New York real estate show or LA real estate show.
Believe it or not, I avoided a lot of those. I have a family of general contractors, and like my parents went through like several big remodels growing up as a kid. So I feel like I've lived a version of that to where I didn't need to watch the shows.
That's probably a good thing. But it's funny because I remember, you watch these shows and I don't know if the price of the home is $2 million or $500,000, you immediately thought, well, you could just offer like 1.7. Or if it's a $500,000, well, you could just offer 415. Lowball them, see what happens. You're going to get way off the listed price. And so that has been the standard protocol for a pretty long window of the last, I don't know, even 10, 15, 20 years.
Yeah. Right. But like also too, like, yeah, things are returning to normal. but also like secular long-term trends. Like I still think we underbuilt like post '08.
Ooh, good point. Good point.
Right? Like Justin, we were talking about this before, but the Oregon Office of Economic Analysis, they looked at household formation compared to housing units. So the number of households that are formed, whether somebody goes off on their own, they move with, they leave the nest, they start their own family, right? The number of households that are formed and the number of housing units is, housing inventory. From 2019 to 2011, no state added more housing units than households. So over a 2-year period, all 50 states in America, more households were created than housing units, right? And part of the thing that led us here is a supply and demand issue, right? And so like, man, I think with people kind of being locked in to low rates and the switching costs being so high, and the fact that I think we've still kind of underbuilt, those things, I think long-term, help with putting a floor on housing. Of course, I don't know where it's going to go, but I mean, I would say just in terms of heat check on the residential real estate, things are normalizing. And that feels scary because it's less lucrative than the alternative, but it is more normal. And I think, of course, the dispersion across geography is substantial, right? Your lived experience buying a $2 million house in San Francisco versus a $250,000 house in Conroe, right? Your range of outcomes are going to be very wide, right? Like, but just speaking generally, I think we're in a more normal spot. But I think lackluster growth over the next decade wouldn't be surprising. But I also think there's some things in the hopper that kind of make it tough for things to drop really meaningfully for an extended period of time.
For sure.
So let's talk about the last thing, back to school. For all our parents out there, your house is a little emptier, which is both probably sad, a little sad and a little bit of relief. I have a 1-year-old, so I don't, we're on year round at this point, which is good and bad. But for those of you that have kids kind of going back to school, you're kind of thinking about back to school stuff. Justin, what, as a parent of kids, school age kids, what's kind of on your mind as you think about back to school?
It was just so sad to see summer go. We love summer, and even summer in Texas when it's 102 degrees or whatever it is. We absolutely love it. And so very sad to see it go. One quick call out, my kids have now been in school. This is the second week. Today was the first day that they were able to have outside recess because of the heat, which, that is just so tough. So yesterday, I just took my oldest out of school early and took him to the driving range to just get him outside. He was completely losing his mind. And so there are some, growing pains and changing pains as you go back to school. But interesting topic. I always kind of go to the public school versus private school debate, Jared. And I think it has just massive financial ramifications. I'm trying to remember, Jared, I was quoted, it was either in Forbes or Wall Street Journal or somewhere 5 years ago on an article. And I basically said that hypothetically, a person could buy an $800,000 house instead of a $400,000 house. So I said they could double their home budget, spend way more on a home if going from to 800 from the 400, if going to the more expensive home meant that they would send their 3 kids to public school instead of private school. In other words, you can spend so much insanely more on a home if you avoid the private school cost. And that's kind of, a little bit of a shining a light on just how unbelievably burdensome it is financially to make significant private school payments. Jared, what do you think about that?
I'm curious, would you age adjust that, right? Because so think about this. I move somewhere with a 1-year-old. I'm making decisions about where they're going to be in school like a decade from now, right? Because I would say like elementary and middle school, the variance isn't as wide as maybe say high school. Like the variance gets wider the older your kid gets.
Yeah.
Right. So if I'm making a decision about where my kid's going to go to high school, right? And he's 1 now, like the probability of it being what I want it to be 15 years from now, or, 13, 14 years from now is very different than somebody who's with a 10-year-old and an 8-year-old moving to a school in a district. So I'm curious if you would change that recommendation for somebody with young kids versus somebody with old kids, or how you would think about age adjusting that?
I think the tough thing, Jared, is my kids are in elementary age and growing. And so, this is a real conversation for us now, whereas, I don't know, 5 years ago it was a little more theoretical. And Jared, the one change is I don't care about cost. And I don't care if I could double my home budget. The question of what is best and what's the best path for each kid between public and private, it just dwarfs any thought of cost. It dwarfs any thought of opportunity cost and what, my portfolio of low cost funds could be worth in 20 years relative to private school costs. And it's just entirely what is best for this child. And so I think that is the one change. You just don't really care. You do whatever it takes to give your kids the best path possible. But even then, that doesn't mean go private. Our two oldest are not in private. Our youngest is. And so that doesn't mean just say yes to spend it, because the best answer could easily still be your public school.
And I would say probably kid fluctuates too.
Yeah.
If you're a private family or a public family, I think that's a weird position to trap yourself in. Like each kid probably needs different stuff.
That's right.
And it might have different resources. And especially like if there's additional needs that like a public school might have more accommodations for, certain types of public schools might have more accommodations for, or a private school that specializes in that. So I think it's really nuanced. I am grateful that I did both. Like in high school, I went to 4 different high schools, fun fact, trivia, both public and private. Some were better than the others, depending on what you were solving for, but there was no perfect answer, right? There was good and bad to both.
Okay, I didn't know you went to 4. So I knew the LA to Memphis move happened in high school, but what was the path? How did you get to 4?
Yeah, I went from public school in Southern California. It was a great school, to a Catholic school in Memphis. I went there to play lacrosse. There was a team crime that was committed where a couple of the players were caught with illegal paraphernalia. And so I wasn't going to play on that lacrosse team anymore. So my parents didn't want me to go, and we kind of decided it didn't make sense for me to go to a Catholic school if I wasn't going to play on the sports team that I had gone to the school to play on.
Wow.
And so I couldn't switch mid-semester. So I went to like a alternative homeschool in a tougher part of Memphis, so I did that for 3 months while I waited to join my sister at the small Baptist school in the spring of my junior year. So so I went to, so it's a little bit of a misnomer. It wasn't evenly dispersed. I went to public school in California for 2 years, Catholic school for 6 weeks, transitional school for the remainder of the semester, and then a small Baptist school for my last year and a half.
That is fascinating. Very cool.
So I'm curious, how do you think about like return on investment with, like you kind of said like spare no expense, but is that just at grade school, or does that impact also how you think about college and like incremental value? Like, is there any like value calculation? Because like I know you want to provide the best for your kids, and a lot of times that supersedes financial logic, but there's also probably some sort of value framework you're thinking about of like, hey, I'm not going to pay, like, even if $100,000 is better for Peter, I'm not going to pay $100,000 versus the 0, because like that value equation's out of whack. It's probably better, but it's not $100,000 a year better. There's a framework of spending the money, which I get and I totally understand. But how do you think about kind of the value equation? And maybe it's more clear in college versus today.
I think it's just clear as mud, Jared. It's so murky. It's so hard to predict these things. And Lauren and I, my wife and I, were talking about this the other night, that, on the one hand, you try to think about it in terms of, okay, like what path are we trying to give them? And I guess what I'm trying to say is you almost think of what is the end product I want my child to turn into, and how do I make sure that school gives us that exact end product? But then, it's life. You don't know what all's going to happen. And so then it kind of changes the conversation to, well, okay, what's the higher floor, or what's the higher median outcome? So do we do the private school? Because even if you're kind of middle of the pack, you still have, an opportunity to go to a fantastic college where if you're middle of the pack at the public school, maybe it's not quite as good, but even that's really tough to decipher. So, Jared, I just think it's totally murky. I'm pretty lost on how to think about it right now, to be honest with you.
And even in Texas, it's even murkier, right? Because let's say you're a, legacy University of Texas and you want your kids to go to UT. You might pick the lesser school because the odds of them graduating with the percent of their class is higher. So, increase their probability of getting into UT.
So, no, that's part of the equation. I mean, I would love for my kids to go to Texas A&M. It's a great institution. So on the one hand, figuring out getting in the top, whatever percent it needs to be for UT or A&M. But then there's also, well, maybe you do private so that you can kind of get out of that loop. And there's ways to get in if you're in private school out of the top, 5%. But then you also have that voice in the back of your head, Scott Galloway. And I think we've mentioned him on the podcast before, but NYU Stern professor. And he's owned some different businesses. But he mentioned this idea of, man, send your kids to public school and just dollar cost average the tuition every month of what it would have been, and then give them that $500,000 brokerage account when they turn 30. And I think, in some of the New York private schools, it was an even higher number in his hypothetical example. But he just made the point that there is no end product that a private school can guarantee you that can compete with a $500,000, $1 million check to a 30-year-old instead of, spending all of that on tuition.
Yeah. I mean, to wrap up, right, it's murky because you are like, what you're trying to do with education is you're trying to invest in your kid. And the problem is every kid is different and the range of outcomes in the economics of that is also different. Right. So it's just like, it's super highly personal. And I think one of my educational hot takes is probably, it's wild. People are like, will lavishly pay a lot of money to go to a private school that has like a, $5,000 more a year median salary than like a public school that's a third of the price, and not bat an eye. But like the early education, they're like, this one's cheaper than that one, I'm going to go with that one, when so much of your brain development happens before the age of 5. Like my thought is like, if you're going to splurge on private, like, do it really early when so much is happening cognitively. And I don't know if I'm in the minority. I don't even know how many options there are to do that. If you really said, hey, I want the Rolls Royce preschool, that might be a good way to spend money. But yeah, man, it's so personal. There's so many different considerations, and like even, right, like even your philosophy, how it applies to each of your kids is going to be different because your kids are different.
Right. That's right.
Awesome. Well, we went a little long on that last one, but that's a good place to wrap it up. We love these lightning pods. They're kind of just a fun way to break it up. If you have ideas for future lightning pods, happy to chat about them. Always love to hear from our listeners, and our YouTube comments. Some of them crack us up. So podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.